Welcome to Financial Accounting. In this video, we will introduce you to the world of financial accounting and its importance in the business world. Financial accounting involves the preparation and analysis of financial statements to provide valuable information to external stakeholders such as investors, creditors, and regulators. Understanding basic accounting principles and concepts is crucial for interpreting financial data accurately and making informed decisions. Financial accounting differs from management accounting, which focuses on internal decision-making within a company. In today's competitive business environment, financial accounting plays a crucial role in providing transparency and accountability to stakeholders. A stakeholder is someone that works for the company and may also own stock of the company. On the other hand, a stockholder owns stock in the company. By following established accounting standards, companies can accurately report their financial performance and position, which helps investors and creditors assess the risks and opportunities associated with the business. One of the primary principles is called GAAP, Generally Accepted Accounting Principles. GAAP is an internal control to ensure finances are reported correctly and ethically. Financial accounting focuses on historical financial data, while management accounting involves forecasting and internal decision-making. Both disciplines are essential for the success of a company. Accounting principles serve as the foundation of financial accounting, guiding how financial transactions are recorded, summarized, and reported. Internal managers work for the company and can view financial reports as often as they decide. An external manager does not work for the company and only has access to financial reporting monthly, quarterly, and annually. The basic principles of accounting, such as the matching principle and the revenue recognition principle, ensure that financial statements accurately reflect a company's financial performance. These principles help accountants prepare financial statements that are consistent, comparable, and reliable, providing users with relevant information for decision-making. There are four main financial statements that businesses use to communicate their financial performance and position. The four primary financial statements are the income statement, balance sheet, cash flow statement, and statement of changes in equity. Each statement plays a unique role in providing insights into a company's financial health. Most companies that are privately held and do not offer stock options, therefore, the top three financial statements are the balance sheet, income statement, and cash flow statement. By analyzing these financial statements collectively, stakeholders can gain a comprehensive understanding of a company's operations, profitability, solvency, and cash flow. We will focus on the income statement, also known as the profit and loss statement, or the P&L. The income statement provides a summary of a company's revenues and expenses over a specific period. Internal managers are responsible for the P&L and daily swings in revenue, expenses, and COGS in the operation. By examining the income statement, stakeholders can evaluate the company's profitability and understand how effectively it is generating profits from its core business activities. Key components of the income statement include revenues, cost of goods sold, operating expenses, and net income. Revenue is generated from selling goods or services to customers. The cost of goods sold is the costing of the process to secure raw materials to create a product all the way until delivered to the customer's shelf, also called landed cost. The balance sheet provides a snapshot of a company's financial position at a specific point in time. Assets represent what the company owns, liabilities represent what it owes to creditors, and equity reflects the owner's claim on the company's assets. The balance sheet equation must always balance to ensure accuracy. A equals L plus E. You may want to write this balance sheet equation down. A equals L plus E. The balance sheet equation, assets equals liabilities plus equity, is fundamental in accounting and provides a clear representation of how a company's resources are financed and allocated. Understanding the balance sheet is essential for assessing a company's financial health and evaluating its solvency and liquidity. Join us as we uncover more about the balance sheet and its significance in financial reporting. Diving into the income statement, a key financial statement that provides insights into a company's profitability or into a company's loss of revenue that led them to bankruptcy. The income statement summarizes a company's revenues and expenses over a specific period, typically a month, quarter, or year. It helps stakeholders understand how well a company is performing in terms of generating profits. Key components of the income statement include revenues, cost of goods sold, operating expenses, and net income. Analyzing these components can reveal trends in a company's financial performance. You may want to take note of the income statement formula R minus E equals I, also stated as revenue minus expenses equals income. Analyzing the income statement is crucial for assessing a company's profitability and financial performance. It provides valuable insights into how well a company is generating profits from its operations. By comparing revenues, expenses, and net income over time, stakeholders can identify trends, make forecasts, and evaluate the impact of business decisions on the company's bottom line. Financial ratios such as gross profit margin, operating profit margin, and net profit margin can be calculated using data from the income statement to assess a company's operational efficiency and profitability. Business owners and managers can use insights from the income statement to make informed decisions on pricing strategies, cost control measures, investment opportunities, and overall business growth strategies. The balance sheet provides a snapshot of a company's financial position at a specific point in time, showing its assets, liabilities, and shareholders' equity. Assets are what the company owns, such as cash, inventory, and equipment. Liabilities represent what the company owes, like loans and accounts payable. Shareholders' equity is the difference between assets and liabilities and represents the owner's stake in the company. Let's delve deeper into the components of the balance sheet. Assets are typically categorized as current assets, like cash and inventory, and non-current assets, such as property, plant, and equipment. Liabilities are also split into current liabilities, short-term debts, and non-current liabilities, long-term debts. Shareholders' equity includes common stock, retained earnings, and other reserves. The balance sheet must always balance, with total assets equaling total liabilities and equity. This fundamental equation, assets equals liabilities plus equity, underpins the balance sheet structure and ensures accuracy in financial reporting. Understanding these elements is key to interpreting a company's financial standing through its balance sheet. Focusing on how to analyze a company's balance sheet to make informed decisions. By comparing current assets to current liabilities, you can assess a company's short-term liquidity. A high ratio indicates strong liquidity, while a low ratio may signal potential cash flow issues. In the world of financial statements and focusing on a critical one, the cash flow statement. The cash flow statement tracks the inflows and outflows of cash within a specific period, providing insights into how a company generates and uses cash. You may want to take note of the cash flow statement formula equals plus or minus operating activities like payroll payments, equals plus or minus financing activities such as a new bank loan, equals plus or minus investing activities like purchasing a new PP&E, which stands for property, plant, and equipment. The cash flow statement has three main sections: operating activities, investing activities, and financing activities. Operating activities represent the company's core business operations. Investing activities involve purchases of assets like equipment or investments, and financing activities include activities related to raising capital or repaying debt. By analyzing the cash flow statement, stakeholders can assess a company's ability to generate cash and meet its financial obligations. Let's explore more about this essential financial document. The operating activities section shows cash flows from the company's core business operations, such as revenue from sales and payments to suppliers. Positive cash flow from operations is a good sign of a company's financial health. Investing activities reflect cash flows from buying or selling long-term assets like property or equipment. Positive cash flow from investing activities may indicate strategic investments for future growth. Financing activities include cash flows from raising capital or repaying debt, providing insights into how a company finances its operations. Understanding these sections helps stakeholders assess a company's cash flow position and financial strategy. Cash flow analysis helps stakeholders evaluate a company's ability to generate cash, manage liquidity, turning cash equivalents into cash, reduce liability maturity by paying debts on time, increase capital through equity, stock and dividends, and fund operations and growth initiatives on future investments. Every transaction in business creates a dual effect, or two different transactions to two different accounts. Every transaction causes two general journal entries in accounting and two T accounts. The T account is used to pre-trial balance each transaction. Then the general journal entry is finalized for the transaction with a debit plus to one account and credit minus to another account. The general journal then is documented in the general ledger, then on the appropriate financial statement for each transaction. T accounts are shaped like a capital letter T. Each transaction affects two different T accounts, sometimes from different financial statements. Assets have a balance with debits on the left side of the T account. Liabilities have a balance with credits on the right side of the T account. Stockholders' equity have a balance with credits on the right side of the T account. Therefore, the balance sheet will balance with debits on the left side and right side with credits to equal each other, or ultimately balance. Back to the stockholders' equity statement, it includes the beginning balance of stockholders' equity, net income or loss for the period, dividends paid to shareholders, and any changes in other comprehensive income. Focusing on how to analyze the statement of stockholders' equity to make informed decisions. By examining the changes in equity components over time, investors and analysts can gain insights into a company's financial performance, capital structure, and shareholder returns. Key financial ratios can aid decision-making when interpreting financial statements. Ratios like profitability ratios, such as ROA, return on assets, and ROE, return on equity, and ROI, return on investment. Liquidity ratios like current ratio and quick ratio, and leverage ratios such as debt to equity ratio provide valuable insights into a company's financial health. Other important ratios include efficiency ratios like inventory turnover and receivables turnover, and market ratios such as PE ratio and dividend yield. By calculating and analyzing these ratios, decision makers can assess various aspects of a company's performance and make informed decisions based on the financial data presented in the statements. Focusing on using financial statements for strategic decision making. Financial statements serve as a roadmap for understanding a company's past performance and guiding future actions. When interpreting these statements, decision makers can identify areas of strength and weakness, opportunities for improvement, and potential risks. Thank you so much for watching. Please consider subscribing for more content or continue through to the next part of the course.